All right, let's talk some more with Chris Recker, Chief Investment Officer at AZA Capital Management, here with me in the studio. Fascinating week, Chris, especially when you compare it with like the month preceding. It's literally like a mirror image. How do we make sense of that? I mean, was it that compelling of a story this week from Powell, Treasury, and the data?
Well, I think from a trader's perspective, we saw the markets do a 50% retracement of the Fibonacci retracement of the one-year move.
Okay,
that's
so
kind of where we saw 1 year, then we came back to retrace half the move.
50%.
That was about a 41.40 on the S&P. Now we've gone back up to the 50-day. The rates move is definitely, this is all rates today, the way we would say it. We've also seen seasonality and liquidity that we saw last November too. That was kind of like the bottom for the bond market, and so things have caught a bid here. And so there may be part of this Treasury funding profile as far as like shifting to short term is affecting liquidity and also affecting liquidity in Euro-dollar markets for collateral. And so we had started to see some changes in collateral where some of the more questionable collateral was changing, was trading a little bit weaker. And so I think having shorter term bills available is going to ease that market a little bit. Okay. So I think there's a liquidity aspect to this, definitely a rates aspect. Some of the prints today in jobs were part of it. But I think, the Fed's got to worry about the Michigan consumer sentiment, inflation, long-term inflation expectations, and then prices paid today.
Which is on the services side.
Services side. And that's where they got to worry about it because we've seen the shift from goods to services.
How much of this is the market saying effectively, and I'm not an anti-Powell guy, I'm not even a big critic. I've tried to give him, I feel like he's doing a pretty good job generally. There are moments a year and a half ago where I did criticize him, but I don't say it from like that perspective. But is the market kind of looking at it and going, hey, actions trump words? And his words here continue to be kind of mashed potatoes, it seems like, basically since the regional bank situation. He wants to get inflation down. He says he's serious about it, but inflation's way above that level, and he's not hiking. And the jobs market and the GDP, everything else says, dude, if you want to hike, you could hike. We could probably handle it. So how much of this do you think is the market saying he's just not serious about maybe inflation?
I don't know. I think that I think Powell is a political animal too, and I think that he's trying to thread a needle. He doesn't. Anytime the Fed raises rates to these levels this quickly, you generally get a recession. The recession happens after the peak in rates, and then you see the bear market after that. And so I think he doesn't want the Fed as an institution to get blamed for any type of serious recession. And so the more patient he is, and look, that we're tighter than 5.5% or 5.33, depending on how you look at effective Fed funds, because of quantitative tightening. And there are other liquidity factors, overnight repo, the Treasury, but at the end of the day, they have to get money and credit down, and M2 is at 75% of GDP. Normally that's been between 50 and 60%. It went up a little bit after 2008. They can keep doing QT for the next 18 months. The economy can grow into it. I think he really is trying to thread a needle here that's going to be very difficult because we have 8% mortgage rates and a lot of other tightening effects in the economy that have yet to be felt.
Why should he be losing sleep, and why should we, frankly, worry about this idea of lagged effects when last year very clearly the stock market paid the price? Yields were inverse to stocks. I mean, we saw immediate effects basically of what he did. Economy slowed down. Technically, by the old definitions, we did get a little recession there if you do 2 quarters in a row, but whatever. And the employment situation remained robust enough. BLS kind of tweaked the definitions. How come we're so worried about lagged effects when it's been a year and a half of this policy and we're printing numbers that nobody thought possible in the economy?
I agree. I didn't see these numbers coming. What I would say is, but we just know that it's uncertain. We know that it's going to be wide. I think that the surprise has been just the strength of federal spending. Another thing is that this just reminds us a lot of 1999 to 2002.
Okay.
Where you had very high asset prices in equities. Then bonds were not overpriced. Value and small caps weren't. And so you just had this one bubble that they had to contend with. Today you have high real estate prices, high equity prices. Bonds we would say have normalized and are pretty much fair value. And so they also have to, so I think they don't want a massive sell-off. I would think they would like it to slowly come in line with longer term metrics. And we talk about where rates are, they really lead to better investment decisions because it's a higher hurdle across the economy. And what they're also doing is I think the real action, you talk about geopolitics, the real action in geopolitics is dollar shortage, dollar availability, especially for China. And then also this effect in rationing credit in the economy. That's the CHIPS Act, small parts of the Inflation Reduction Act. So the areas that these high rates have gone up, but the areas where they want to direct investment in the industrial side and tech side are getting subsidies. So I think the real political action is in Congress to the effect that there's consensus among the parties on how they want to deal with what's strategically important to the United States and its allies. And then also the dollar is we make dollars available to our friends and less available to people that are less friendly.
So part of that there is an explanation of how we are so strong because they've been targeting funding and spending in areas that were effectively stimulative with the Inflation Act, et cetera, support for chip makers too. The other thing that I want to come back to the bond move for a moment. You've got a chart looking at the 30 years. First of all, how come the 30s? How come so far out? Because I'm looking at two charts to you from the 30s. We spend so much time talking about the 10s. What do we get when we look even further?
Well, I think we've been trying to. We took a position in a longer term bond ETF in the last 2 weeks, and
good trade.
Yeah, well, we'll see. It's too early.
So far, good trade.
It's too early.
Take it off.
No, we're not going to do that. We do talk about a risk barbell. We hold a lot of short-term treasuries, and we started to initiate a position in long-term treasuries. We'd love to build it. We hope this isn't our first buy. So what I would say is the long bond is a way to we think, given the risks that are out there, a barbell, like a barbell in duration makes a lot of sense for people. And so when you look at the 30-year treasury, it's a way to given convexity right now, the downside risk for a 1% move on a 30-year is basically 10% down for a 100 basis move and then 20% up. So the risk-reward trade-off for these types of situations is very good. And what you see there, I think, is the real yield on the So I think at a 2.5 to 2.7% real yield, it might be a little bit below that today. That's a good compensation for an investor in a long-term bond. What we saw, what it took to get rid of the 1999 bubble was a 4% real rate. We would love to see that, but if break evens right now are about 2.5%. If you get anything over 5%, and the other thing you notice with like the 10-year, even these longer-term bonds is during these rate hike cycles, the long end generally comes up to the peak of Fed funds. Maybe a little, may get something greater than that, but it's a good time. And what we saw in the last 2 weeks is an extremely oversold condition with the highest real returns that we've seen in basically the last 20 years of this century.
Wow. That's the other chart. If we pull that up real quick, because we're almost running out of time, but I want to put that in there too, because that's really important. Because that would almost kind of argue that the bond market just got so extreme in the selling. This is the Z-score that goes back almost, that like
you said. 1979. This is one of the trends that we look at. And one way to think about it, all it is a proxy for a really quick rate hiking cycle. And the long end of the curve finally caught up to the cycle. And so this is the most oversold we've seen bonds, this bond, from a trend basis, the way we would measure it on a longer term trend, very oversold.
Last thing I would say is there's a lot of folks that right now are piling into the 2-year trade because they go, I don't really have to make a big macro call. I just have to think that inflation's coming down regardless of reason. Seems like if you're in the 30-year trade, got a little bit more bearishness in the economy built in there.
This is the largest trade we have at our firm.
Okay.
It's a third of our assets.
Wow. Okay. So is there a little bit more of a economically bearish implication when you go out, willing to go out that far on the curve?
Well, we don't know. Our models, a lot of our stuff is model driven, so we don't know if we're going to have stagflation or deflation.
Okay.
And so when you get on the short-term part of the curve, in the last, we've had this bond bear market. We think that higher rates are bearish for risk assets. And so this is just really a safety play. We haven't seen the stagflationary move or the deflationary move. I think I can say outside of the models, I'm more leaning toward deflation personally.
Okay.
But we're going to let the data tell us what happens.
The risk to this trade is that we get like healthy early cycle behavior.
True.
Yeah. Okay.
True.
All right. Thanks, Chris. Great to catch up as always.
Thanks, Oliver.
Appreciate the details.